Welcome everybody. Welcome to the 40 Finance YouTube channel. My name's Jeff Beers. Today I've put together 6 stocks that have strong buy ratings from a number of different analysts. So if you're looking for who the professionals are picking over the next 6 to 12 months, then this is the video for you. All right, first on our list today is Autozone. And I think everybody has an Autozone in their zip code or city somewhere. Autozone obviously sells auto parts, both retail and online. And I like Autozone in this sort of economy where you can't tell which way things are going in terms of the stock market, because auto parts in general have a need, regardless of where the economy sits. And in fact, you could argue that if we were to go into a recession, a company like Autozone would perform better because folks would try to take some of that costly maintenance and try to do it themselves. Now, the big threat with Autozone over the past, let's just say 5 or 6 years was, would Amazon eat their lunch over time? And as it turns out, Amazon isn't really that great at selling auto parts. So the experts at Autozone have really carved out a niche and a need, not only for their retail store to give instantaneous access to auto parts you need, but also their online as well. Autozone's a pretty strong stock. You got a P/E ratio today of 2014, a forward PE of 17.34, so that's always good. We're looking for forward PEs to go down a little bit. You can see that over the past year, it's really been on a high uptick, especially for a $1,000 stock. This is a growth stock, so there's no dividend being offered. But if you would have jumped in a year ago at about $750 a share, you'd be up, over $300 right now, which is pretty impressive. All right, looking at the tip ranks dashboard for the consensus analyst price target, you have a strong buy rating, 8 analysts saying buy, 0 saying hold or sell. You got an upside of only 4.9% on the median price right now. It's at $11.85. However, you've got a high bar of $12.50 for Autozone, and then the low bar comes in at $1100. So I would say with Autozone right now, structurally, you're in a good place to buy, right? The company's doing very well. I wouldn't say that it's going to rocket ship off to $2,000 anytime soon, but if you're looking for an industry that produces revenue regardless of the economic situation, then you can trust Autozone as a good company to invest in. All right, number 2 on the list is a company I've covered in the past, Penn National Gaming. Penn National Gaming, which owns a host of horse tracks and video slot machine type casinos in underserved markets. So not in Las Vegas, not in New York City, but sort of Midwest type markets. And Penn's been a little bit of a roller coaster ride, but with the legalization of gambling going back on and the fact that Penn just closed 1 or 2 of their underperforming properties, they're sort of back on the radar now. And when you take a look at the stock as a whole, we got a PE ratio of 23 today. It drops all the way to 949 because they've been slashing some of those losses. And I think most intriguing for me is that a year ago at this time, Penn was up, upwards into $37, $38 range. We're down to $19.64. We got a PE that's going down. This looks pretty promising if you're interested in getting an affordable piece of potentially the sports gambling market. Looking at the tip ranks dashboard, we got 6 buyers, 1 holder, and the median price target of $29.83, which is a 51% upside. And frankly, that 51%, you're not even going to get back to where Penn National Gaming was just a year ago. So assuming that the company continues to push forward with cutting losing properties and they inherit some gains from sports gambling coming online, I honestly think that Penn National Gaming is a good bet to get you some quick returns over the next 12 to 18 months. All right, next on the list is another stock that I recently covered, CBS Corporation. So CBS has been really digging in on the sort of move to OTT programming or cord cutters or however you want to look at it. They've invested a lot more into their digital properties, and they've been pushing more for exposure to different audiences, and it's really paying off. So right now you got a PE ratio of 649, which is almost unbelievable for a company this size. 649. The forward PE does go up to 795. So not exactly the same direction as some of the others, but frankly, PE at 795 is looking pretty good. You also get a dividend of 1.41%. So an added bonus there, if you want to hold it for 2 to 5 years, you'll almost instantaneously reap some of the rewards back. And when you look at the 1-year chart, CBS has basically been in the $58 range up until December of last year when the stock market went down, and they really have yet to recover. So they're at 52 right now. They can get as high as 58, 59, plus the dividend. I think this is a pretty good play because CBS as a brand isn't going anywhere. They've got some key sports properties locked up for the foreseeable future. You get the bonus dividend, and I think what you're seeing right now is they're adjusting to the digital atmosphere very well. And for CBS, I missed the slide on the tip ranks dashboard for CBS, so sorry about that. But they do have a target estimate according to Yahoo's consensus of $61.57. So you got about another $9 in there that analysts are looking for over the next 12 months, plus the dividend. So overall, take a look at CBS. If you can buy it maybe on the next dip coming down, get it in around $49, $48, could be a great play for the long term. All right, next on our list, a stock that needs almost zero introduction, and that is Facebook. Facebook continues to get bad press from a media privacy standpoint, but I'll be honest with you, stock analysts and investors in general are starting to overcome the bias in the privacy and the negativity. They're starting to look past the headlines and dig deep into the numbers, and the bottom line is Facebook is printing money. That's the bottom line. So you can say all you want about, legislation and regulation. They may have an impact over the long term for sure. But right now, the company just can't get out of the way of money flow. I mean, it's just pouring in. You got a P/E ratio of 29.15 today. So a little bit higher because it's a tech growth stock. The forward PE drops to 20.98. So heading in the right direction as that's going down. No dividend. Last year, we reached a peak in the neighborhood of $218. Right now, we're at $196. I would say there's at least another $20 in Facebook stock. So the next time the market dips, might be a great opportunity to jump in and grab some shares and not miss out on what may become over time $1,000 stock in the next, 5 years. That's how quickly money is pouring in. Okay, tip ranks dashboard. Facebook is a very popular stock, so there's no shortage of analysts covering it. We have 39 analyst ratings, 35 buys, 4 holds, a median price target of $221, which is a 12.64% upside. On the high side, you got one analyst coming in at $250. On the low side, you got a $175, probably for one of the holds, one of the 4 people that rated it a hold. But over time, guys, 24, 36 months, I don't think you can go wrong with Facebook. There's much riskier plays out there. Okay, next on our list of analyst favorites right now, we've got Planet Fitness. So more than likely you have a Planet Fitness in your zip code or city. They obviously run fitness centers, gym membership type things, but they also have online stores where they sell exercise equipment. They sell branded materials like t-shirts and things of that nature. And they recently announced a partnership with Kohl's, which could really open up a new stream of e-commerce for them if they took over selling, let's say, treadmills, benches, yoga balls, whatever, under a Planet Fitness branded name using Kohl's reach and distribution. I could see it being a nice added bonus to their line. If you look at Planet Fitness over the past year, it's been a great story. They were around $44 this time last year. They've went up almost in a direct upward pace, if you will. Add another $30 to the stock price. PE ratio is a little high right now. It comes in at 70, but the forward PE does drop substantially down to 40. So there's some promise there that efficiencies are starting to catch up with themselves. You may want to wait for a dip on this one and try to get in the 65 range if the market does go down. But from a growth standpoint, Planet Fitness is doing all the right things. Looking at the Tip Ranks dashboard, we have 8 analysts, all who put a buy target on Planet Fitness. Their median price is $82, which is a 7.56% upside. You got one analyst with a high of 88, and you got the low coming in at 70. So overall, there's probably, I would say a good 8 to 12% yet to be had on Planet Fitness. If you can sneak in at a dip and you see some positive momentum in basically consumer discretionary, then you know that gym memberships are going to sell more because people aren't as worried about signing up for another monthly service. So pay attention to consumer discretionary, and if you see a lift in people's income, Planet Fitness might be one place to invest in. All right, last one on the list today is Ameren Corporation. So Ameren Corporation is a drug company, and they sell mostly around cardiovascular healthcare, right? So they have drugs that assist with cardiovascular problems. And most notably, they've come out recently and mentioned how basically profits are above what they expected. So earnings are doing good, profits are doing better than expected. And the big news though is they have a drug coming out, Vasco or something like that. It's not approved yet, but the trials are going very well. And anytime you hear that, stock market investors are going to be swirling around. If they get approval for this drug, then you could see a massive liftoff as it's a whole new revenue stream coming in for Amarin, okay? Right now, this company is not profitable. We have a PE ratio that doesn't exist, but looking ahead, they're already marking a forward PE of 82, right? So profitability does start to come into play in the next 12 months. When you add on the cardiovascular drug that's not even approved yet, if the moons align and everything goes great, then you're talking about an opportunity to get in with a drug company right when you want to, which is just before that drug goes public. So big opportunity here with Amarin. All right, looking at the Tip Ranks analysts, we got 6 reporting in, all with a buy rating. We got a median price target of $32.83, which is a 41% gain that they're projecting over the next 12 months. We have a high bar of 51, a low bar of 23. I say, guys, pay attention to Amarin. Mark it as a stock to watch in your watch list. Make sure you're following the news feeds. If you play that game with pharmaceutical stocks and you want to get in on the next one that gains a drug approval, then Amarin is ripe for the taking here. Just make sure you understand the risk that even the best drugs who reach through dozens and dozens of positive clinical trials, there can always be a last-minute concern that takes those drugs out of approval and it'll instantly drop the price of Amarin. So just understand the risk there. Okay, so those are 6 stocks that analysts are in love with right now. I think all 6 offer a solid opportunity. Some have more gains in them over the short term than others, but from a long-term perspective, I think each of these 6 stocks is a great addition to your portfolio if you're looking to diversify into a new ticker symbol. Guys, thanks for watching. I really appreciate the support. Please like the video, share it with your friends. It makes a big difference. I'll see you on the next video.